All right, folks, welcome to Investing for Beginners podcast. Today we have episode 369. So we are going to answer some great listener questions. But before we dive in, if you have any questions, please reach out to us at newsletter@einvestingforbeginners.com. We'll be in the show notes. You can also send us questions on the Spotify app if we're listening to the podcast via that, or you can reach out to us on the social machines, in particular the X machine or Twitter. Send us those questions and we'll be happy to read them on the air and help you out any way we can. So with that, let's dive into the first question. This is from John. So, hi, I enjoyed your podcast very much. Listen to all the episodes I can. I too purchased Disney stock a few years back and was up for a while, but now I am down a bit for an extended period of time. I've been reluctant to sell for not wanting to lose money, but am I wrong? And should I just peel the Band-Aid off and move on? Or was I right in holding on in hope of recuperating my investment? I bought a lot of shares when they were in the 130s, and I doubt it will ever get back to that. Yet I can't hit the sell button. Laugh. Any advice would be much appreciated. Thanks for any info you can pass on to me and other listeners. So great question. And I'll turn it over to you, Sir Andrew, for the first take on this.
Sounds awesome. Well, let me make it short and sweet. First, thank you for listening. Second, this is a great question. And I appreciate the honesty and the feelings around it. Is very hard sometimes to sell a stock, especially at a loss. And I feel like we all go through this as investors. If you hold individual stocks, you're going to inevitably come up with this. And it happens whether you've been doing this for 10 years or 10 days. So my short answer is it's different depending on what stock you're talking about. So you really have to look at Disney kind of in a silo and think about, do I still believe in the fundamentals of this business or not? That's kind of where, for me, the crux of the answer would be. But I think that's the first part. And then the second part, you have to get over the psychology of ripping off the Band-Aid, and we can talk about that later as well. But for me, the answer to the question is always, how do I feel about the business? What has changed? And how do I feel about not the business today, but 10 years down the line?
I'm of the same camp. So I bought Disney during the pandemic for my daughter. So I was starting out and I let her pick some of the companies that she invested in. So she chose Disney, Spotify, Roblox, and Amazon, because those are the things that she uses. So ironically, she's probably destroying me. I haven't looked at her portfolio recently, but between Spotify and Amazon, they've done quite well. So we bought Disney at a much lower price. And then we bought a little more when it was a little higher price. And since then, it did not do well. And we actually ended up selling our shares of Disney. I say our only because I bought them, but it was really her invested in it. So I ended up selling them for her because she didn't like a Disney movie. And so she wanted to sell. So I let her make that decision. But like Andrew was saying, when you're in this situation, it's really hard. And it's probably the hardest decision. Buying is stressful, but selling is way more stressful. And because we feel the loss way more than we feel the win. And so the psychology around that is it really prevents us from maybe doing the right thing or hesitating way more than we probably should. The way that I would try to look at this is, if you have a thesis or if you've written down something of why you bought the company in the first place, and then looking at that and realizing, okay, these ideas are the reason why I bought Disney are still in play, then it becomes a little easier to make a decision, yay or nay. If you unfortunately did not do something like that, this would be a good time to remind yourself, note to self, write down why I buy a company. You can do it anywhere. It doesn't have to be anything fancy. It can literally be a notes app on your phone, or a sticky note if you want, and post it to your wall, whatever works for you. Low key, high key, low tech, high tech, whatever works. Anyway, once you have an idea of why you bought a company and you look at the reasons why it may or may not be a reason to hold or not, I think then it becomes an easier way to do it, and I guess to think on it. And so that's, I guess, really how I try to think about it. It doesn't make it any easier, for sure. So you mentioned the psychology of it. What are your thoughts on kind of how to work around the mental aspect of selling.
There is something about the way we are wired where we just really don't want to take a loss. We've talked before about how taking a loss kind of is a way of waving the white flag to say, I made a mistake. And that's hard and painful to do on its own. But there is something about, I've come across it. I feel it myself. I've seen it in family members. You hear about it. We get questions about it. You just don't want to take a loss, right? And it feels better to say, I'm going to wait for this to recover before I sell. So, at least I'll break even. I didn't lose any money, and then I can buy something else. And so, trust me, I understand the logic behind that. I understand the feelings behind that. The one thing that I try to hammer home, and it's probably not as successful as I would like of a message, but it's like, yes, you can wait until that comes break even and you didn't lose any money. I'm putting this in air quotes. But what are you losing out on by not selling? So what else could you have bought in that time that you're waiting for it to break even that you're just going to completely miss out on because you're scared to take a loss? So if it takes Disney 4 years to break even, maybe you earn, I don't know, I'm just throwing random numbers out there. Maybe it takes 4 years for them to break even. The stock finally recovers. You're up 30% in 4 years. But what if the market's tripled in that same time frame? Well, then now you're not feeling as smart, because if you would have taken the loss in Disney, ripped the Band-Aid off, and then bought something else that's done much better, you're at the end of the day in a better spot. That's how I would try to frame the reason why you want to pull the Band-Aid out. Try not to think of when you bought and when you sold, but try to have a longer term horizon of like, in 5 to 10 years, I'm going to have a better outcome because I found a better opportunity for a business that's maybe not struggling, maybe a stock that's a better deal. So it all depends on what your other options are. And that's kind of investing, stock picking, at least. That's the game of it.
Yeah. And that's the hard game of it. How would you feel if, let's say, the position sizing, for example, let's say that this company was, 0.25% of your portfolio versus 7%. Would that influence your decision on selling?
Yeah, I think that's a great point. If you're really trying to, it's different, right? Because you could be doing this part-time, you could be doing it as a hobby. For me, somebody who approaches this from like a full-time mindset, I'm trying to allocate my time to what's best for the portfolio. So in that kind of a scenario, it makes a lot more sense for me to spend time, research time on, like, to your point, the bigger position portfolio, and not worry so much about little small positions. So yeah, I totally see the logic in that, but I know it's not always simple, and I fall victim to it too, because when you have all your stock tickers on a spreadsheet, human nature is to look at the ones that are doing the worst, and those are going to be the ones that drive you insane.
Yes.
So yes, logically, we should all be carrying more and spending more time on our biggest positions. Some of my best positions are my biggest positions, and I spend not nearly enough time on them because they do pretty good. And it's like, it's so logically counterintuitive, but that's just the way we are wired as stock pickers.
Yeah, for sure. The last question I kind of have is, how do you feel about, this was some advice I got, to kind of put it in perspective. So I bought PayPal, which we've talked about ad infinitum, and I won't go into all the details of that. But I bought a bigger position in PayPal, and I bought a very small position in Palantir. It was literally $100. And so so that was more of a psychology experiment than anything, because it was down for a year and a half or something like that, and I never questioned selling it, because to me it wasn't. I don't want to say it wasn't a serious investment, but it really wasn't. And so it was $100 I was willing to basically gamble to see how it would feel about investing in a company like that. And now it's, up, I don't know, 50, 70%, something stupid like that. And it's interesting how my perception has changed about that position because of the psychology of being down and then being up a lot. So then you have that. And then I have PayPal, which was down a lot, but it was because it was a much bigger position. to your point, it occupied way more of my time thinking about, what do I do with this? What do I do with this? And I got some advice from our friend Brian Withers, who suggested that I trim instead of selling it outright, was trimming it. And so that's what I ended up doing is I sold about half of what I owned, and I feel better about the position. Also, it reduced my cost basis too. So it's closer now to where the original investment, where it's trading at now. So I air quote, feel better about the position than I did before. So what are your thoughts about that? Like maybe trimming some of the position and then seeing if it recovers or something along those lines?
Yeah, I like that kind of mindset shift. So was there something about PayPal itself where maybe your conviction was lower than when you bought it, and so that kind of played itself out in the trim?
Yeah, for sure. I definitely felt that, management wasn't taking the company in the right direction, and it seemed like it just was underperforming compared to what the potential was. And so it's a little bit like watching, a baseball player who you can see has all the talent in the world, but only hits 240 instead of hitting 280 and, lots of home runs. So that's the way PayPal felt to me. And so I guess at the higher portfolio size, it felt like it was underperforming. And now that it doesn't, now that it's not as big of a size, it was 5-6%, 7% range, and now it's 1%. So it feels better, if that makes sense.
I mean, I did something similar too. I had Starbucks as a 10% position. And so that's like putting it up there in one of my top biggest positions. And then out of nowhere, here comes Alphabet as a wonderful opportunity. So I was so frustrated. I was like, man, why didn't I wait to load up into Starbucks? Wait to see if there'd be another opportunity. Felt like I used up all of my opportunity on Starbucks. And then it's like, well, actually, I can just trim it back. And if I feel like I did that Starbucks and Alphabet's opportunity was equal, then trim the Starbucks and put them equally in Alphabet and Starbucks. And so that psychology, for sure, that helped my psychology of like worrying a lot less about Starbucks itself. I can't remember who the investor was. I don't want to say it was George Soros, but something's like whispering in my ear that maybe it was. It was in a book. And maybe this was I don't think it was Joel Greenblatt, but somebody had written about this investor. And he basically said his gut would tell him when he had too much money in a position, or like if he couldn't eat or couldn't sleep or something, like his body was physically telling him you're not making the right choice. And so I thought that was a very interesting thing.
Yeah, it is. It's funny, we spend so much time obsessing about numbers and financials and all that stuff, but what really drives our investment decisions and our returns is our brain and our stomach.
Yeah, exactly. There is wisdom to that. Like we all have strong convictions on the different stocks we buy. That doesn't make us right. If we're right 60% of the time, we're really good stock pickers.
Right.
So to have these things where you're doing things in your portfolio to reduce the stress level, I think it's beneficial.
Yep. I totally agree. All right. So let's move on to the next question. So we got Dear Andrew and Dave. Love your show. Thank you for teaching me so much and giving me the confidence to be patient. I have 2 follow-up questions about 2 of your favorite themes, Buffett and dividends. And he's got that right. I read the Warren Buffett is committed to giving most of his fortune to charities and is supposed to be used relatively quickly. As much as I understand, his fortune is in Berkshire Hathaway stock. What does this mean for the price of the stock the day after? So that's the first question. The second question is, I created a small dividend portfolio in order to learn more how it works for me. I wonder if I should use an auto reinvestment option or invest the dividends myself in stocks that are cheaper or more promising at the time, regardless of the stock that it distributes. So this is a great question from Ofer. So let's tackle the Buffett question first. So what are your thoughts on the Buffett question?
I guess I'll kind of punt on it a little bit in that I haven't closely followed what Buffett's giving. I'm sure I know he's publicized in the past what he plans to do with his shares, what he is doing with his shares when it comes to his philanthropy. So I don't want to comment on the specifics because there could be short-term movements that I'm just not aware of because of whatever he has said. But Berkshire, and probably Berkshire more than even other stocks, but stocks, businesses in general that are valued rationally in the market, the long-term value of Berkshire stock is going to be based on the core Berkshire business, how Berkshire's business does over the long term. So yeah, I mean, we could speculate about what's going to happen with Warren Buffett and all of this, where the price is going to go on any given day. But some billionaire could stub his toe tomorrow and decide to sell a bunch of his stock in something else. And, we can't predict any of that either. So I understand the question. I think it's good to think about a lot of these different factors. But to me, this is one of those kind of short term, throw it in the short term bucket versus the long term bucket. So if you're holding Berkshire or you're thinking about Berkshire, I would to me, the longer term view is easier and more reliable way to try to think about analyzing the stock. What are your thoughts on the whole Buffett, Berkshire kind of thing?
Well, I don't remember the specifics, but he has said in the meetings many times that he is going to give the vast majority of his wealth away to charities. And he's going to leave a small amount for some of his family, but the vast majority is going to go to charities that I think it was a large part of it was to the Bill Gates Foundation, the Bill and Melinda Gates Foundation. But because of their divorce, I think that some of that might have changed. Again, I don't remember the specifics of that. I also seem to remember that he was going to recommend that they sell the Berkshire stock and put it in S&P 500 index until the money is used for the specific charities. And I believe some of the charities were already designated how much they were going to get and whatnot. And I think his thinking was that by putting it in S&P 500 stock, it could try to remove some of the volatility that he probably is anticipating after he's no longer in charge of Berkshire, after he passes. Questionably, there will be a drop. I don't know how big, it's anybody's guess, but I wouldn't say for a certainty that I predicted that there will be a drop, but I think there's going to be a drop. If there's what's the word I'm looking for? A founder-led company that's driven by somebody's reputation more than Berkshire, other than Elon Musk and maybe Jeff Bezos at Amazon, I'm struggling to think of somebody that really, helps drive some of the value just by the Buffett name. And when he's no longer there, I think it will have an impact on the price of the stock. But to Andrew's point, if the people that are taking over are as good as Buffett thinks they are, and we think they are, then I'm comfortable owning personally Berkshire after Warren is no longer there because the core businesses are intact. What he set up can and should last for a long, long time. Really, the I guess the unknown is the whole equity portfolio, the stocks that he has bought over the years, the Apples, the American Express, the Cokes, and so on. But one of the things, there's been some commentary on Twitter recently that some people think that he's reducing some of his positions in these companies to give Greg Abel, who he's anointed as his successor, the optionality to be able to do other things and not have to carry that burden of having a 50% position in Apple. We were talking about stomachs earlier. That's a strong stomach kind of position for a company that size. And so I think he wisely is probably reducing his exposure to that company to give Greg Abel more optionality and not have to deal with that big of a headache taking over Berkshire. But that's all speculation. He's not said that in words. I don't know that. That's just other people saying it and me parroting it back. So take that for what it's worth. I guess that's kind of my thought on what I think he's going to do, what's going to happen, and how he's planning on using his wealth, which is awesome that he's going to do something like that. Instead of just giving to the family and having them blow it in a couple generations, it's actually going to go to use for something good, which is awesome.
Yeah, totally. What are your thoughts on the second part of the question?
My take is, and this is what I do for myself personally, and I like it because it removes me from the equation, is that I just automatically renew them. So if I own Google, which I do, and they pay a dividend, which they now do, yay, then that dividend gets reinvested in more Google stock. And I have zero problems with that. I can see the logic of having the cash put in your account and then you can invest it in something else. I see the logic of that, but I also know that the best way to continue compounding is to not interrupt it. And so if a company like Google is growing and then they're giving me dividends that I can reinvest in a growing company without me having to do anything, then to me that's kind of a no-brainer. And again, it takes me out of the equation. It's one less decision I have to make. And if I like the company enough to own it and continue owning it, to me that's an easy decision, because that Google stock is going to be more valuable than if I obsess about something for the next 4 months and spend 42 cents on buying, a portion of that company. It's just not, I don't think that's the best use of your time and effort. For me, I would do that. I see the logic, but that's how I would do it. I think I know how you would respond.
Drip, drip,
Drip, drip.
drip. I love that, like how you describe that. Like the less decisions you can make, in theory, the better decision making you will make. So reinvesting, to your point, reduces the number of decisions you have to make.
Mm.
And it's like you're gonna handicap some of your best ideas because you're trying to always find new ones.
Mm-hmm.
There's a lot that could go wrong.
Yeah.
And yeah, I mean, you'll get some stocks where I'm glad I did that, but you'll get others where you're like, Google, why didn't I just
Right.
leave it in there?
Right.
So
Yeah.
I
Like
understand.
how many times have all of us raise our hand, look at something and we didn't buy it, and then you look 6 months, a year, 2 years later, and it's up 72% or something crazy like that, and you didn't have the chance to buy it. You're like, oh my God, I'm such an idiot. I mean, it's the same feeling with reinvesting the dividends. At least that's the way I look at it.
Oh yeah. I mean, some of my best stocks are the ones I pay no attention to. So
Yeah.
like, is there some inverse correlation between like how excited we get about a stock and like how well it performs? Possibly. Right. It's like, oh, that moat's too simple.
The less I look, the better it does. Okay. All right. Stop looking so much. Correlation, causation. Let's move on to the next one. So we have, hi, Andrew. This has been a really interesting, and I think I've got my first DCF working, so congrats. I have run a sensitivity analysis on the first company I valued, as I am aware changes in inputs can significantly alter the valuation. Do you have any guidance on comparing the DCF valuation to the current share price in terms of a decision on whether to buy or not? For example, I have valued a company whose fundamentals look good to me, but my valuation is around 25% below the current price. Many thanks, Joe. So fantastic question, Joe. And Andrew, what are your thoughts on this?
Do you want to break down DCF real quick for somebody who's...
Yes. So to jargon aware everybody, DCF stands for discounted cash flow, and it's a valuation model that you can use to help value a company. And it basically, what it does is it takes free cash flow that a company earns and it projects it into the future, and then it discounts it back to the present value for today, basically accounting for any impacts on inflation on the cost of money. And the basic premise is $1 today is worth less than $1 5 years from now because of the impact of something like inflation. So when you run a DCF, what you're doing is you're trying to determine the value of a company 10 years in the future, but valuing it at today's prices and trying to determine whether it's, a good price or not. Kind of like buying a car or shoes, same kind of idea.
Yeah. Like if you put $100 into a savings account, you can assume where you think that'll be in 10 years. And yeah, you just get some simple compounding from that.
Yep, exactly.
And then you can assume this probably won't buy me a Big Mac in 10 years either.
Probably not.
The way inflation's gone.
No.
I mean, we joke, but that's kind of how a DCF works, is you are accounting for inflation and everything. So to me, I think it's telling that you like the fundamentals, but then the DCF is telling you maybe this thing's 25% too expensive. I think that's a good thing. I think one of the values of a DCF tool for me personally is that if I'm really excited about a stock, the DCF can kind of be like,
brakes on.
Hey, yeah, like put the brakes, like maybe this thing's a little expensive. And so then now you can relook at the fundamentals and like, do I still think that these fundamentals are really great or not? Not to say that they're bad, but you take a second look, you try to be more rational, and then maybe that can help you decide whether it's a buy or not. But the DCF kind of puts that barrier there to force you to think deeply, think again, and kind of put some time between like your excitement and the final buy decision.
Mm-hmm.
I think it's good that your DCF came up like that, because now you can go back and reevaluate.
Yep, I agree. I agree. The power of the DCF or using any kind of model is the thought process that goes into determining what the inputs are going to be. And yeah, you can plug in numbers and just, see what it spits out, and that's easy. But if you're trying to be a thoughtful investor, then you have to think deeply about the inputs and their impacts on the valuation. You have to always remember too that evaluation using a DCF in particular is sensitive to the inputs that we put in. And bottom line is they're guesses. I mean, we do not know for sure how much Google will grow tomorrow. We just don't. And to think otherwise is foolhardy. And so when you're valuing a company, really the power of it comes into analyzing the fundamentals, like Andrew was talking about, determining what is the mode of the company and how does that impact the growth in the future of the company. And you take a company like Google, which appears to have a really strong moat and a growing moat, and that indicates that maybe the growth that you could anticipate could be good for a long period of time. But if you don't really understand the fundamentals of the business, it's really hard to assess that. And so when you're using a DCF, it's not a tool to help you figure out exactly what it is you're going to pay. It's a tool to figure out if you're in a ballpark of whether you think this company is fairly valued or has an opportunity for it to be a good investment. Some people can mistake them as like, I'm looking for the exact value I'm willing to buy at. I run the DCF and the value comes up at, let's say, $50, and I will buy if it's at 48.92, but a penny over that, I'm out. And that is missing the forest for the trees. And so you need to try to make sure that when you're using any of these kinds of models, it doesn't matter whether it's a DCF or reverse DCF, dividend discount model, Black Scholes model, any of those kinds of things, that you're understanding the inputs that you're putting in, and you have a good handle on the business and all the different components of the business. And that's really what a DCF helps you do, is because it forces you to confront those fundamentals and understand if you have a good handle on the company. And this is a great question to ask yourself. As Andrew was saying, if it comes up as overvalued, then it really forces you to go back and look at the fundamentals and go, oh, was I right? Is the balance sheet really that strong? Are they really investing that well? I mean, those are core questions to ask, and we all make mistakes, and a DCF can help you catch those. And that's one of the things I love about using a DCF.
Well, actually, yesterday in our valuation hackathon, Gilbert, we were doing the valuation for JP Morgan Chase, with the aftermath of the election and everything. And Gilbert said, like, just that process, as we were walking through, as I was sharing my screen, he was like, this helps me think about shareholders' equity, helps me think about the loan book. Like, just by going through those steps, you are helping your brain walk down the path of analysis. And that's actually a hard thing to do. Like, it doesn't come naturally to just say, okay, I'm going to research this part of the business and then this part of the business and that part of the business. I mean, for me, like, maybe I take it to an extreme in my life. Like, if I have to remember to grab my laundry, I'm putting the laundry basket in eyesight. Otherwise, it's going to stay in the dryer for 3 days.
Right.
So for me, I need those visual cues. But as investors, I think that can also be the different types of cues. DCF valuation is a great way to cue your mind to look into these different parts of the business. To your point, to look at the reinvestments and really try to deeply think about what we're analyzing.
Yep, exactly.
Well, last thing I'll throw in with that is try to think about what the growth rate is too. Like, you might be okay paying 25% too much if you think the company's going to grow like 12% a year, if you have a good reason to think that. So the growth rate also matters. So I like to go in Excel and like project out the growth rate and see You know, even though something's expensive, does the company grow into that?
Mhm.
The numbers are going to kind of play out how they are. But that, to me, that has also helped. It's actually
Mhm.
been a game changer in the way I pick stocks as well. Like, it's not just about how cheap or how expensive.
Mm-mm.
It's how much growth am I going to get? And then you bake in how cheap or expensive. I mean, something might be 25% cheap, but is that 25% cheap only going to grow at like 3% a year? Maybe for somebody that's appealing, but for me, I'm looking for something different. So
Right.
try to think about growth too, not just if it's cheap or expensive.
Yeah, well, that's very, very good takeaway. That's super important to consider because that's baking in part of your returns, right?
Yeah, 100%. So, you know, hopefully that answers the question. Hopefully it gives you more insights, and, you know, the DCF to like beat the dead horse. It's part of the process. It's not the end destination. The valuation hackathons can be a great way to test your DCFs in the wild, work with Dave and I and do DCFs together. So that's part of Value Spotlight. If listeners out there haven't heard about that, we do regular valuation hackathons. We're on Zoom. We're breaking down any company you want. We did Lululemon yesterday and
Yep.
JP Morgan Chase. So
Yep.
no company is off limits.
No.
And that was pretty fun. So shout out to Gilbert for being there with us and giving us some ideas. And if you want to be a part of that, that's all inside Value Spotlight.
Yep. Exactly. It's well worth the time. I know I learn a lot, so it's fun. All right. Well, with that, we'll go ahead and wrap up our show for today. I wanted to thank everybody for taking the time to send us fantastic questions. Again, if you have any questions, you can send them to us at newsletter@einvestingforbeginners.com. That is in the show notes. You can also send them to us via Spotify, the app that you would be probably listening to the show on, or you can reach out to us on socials, in particular on X or the Twitter machine. So any of those places, you can reach out and ask us questions, and we'll go ahead and answer them on the air for you and help you out. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.